My name is John Nayland. I'm the AFSA Retiree Vice President. Welcome to AFSA. This is an ongoing series we've had over the years on federal benefits, and the one today is on long-term care. And my wife and I signed up for the federal program about 5 or so years ago, and to us it was the right decision, but it's an individual decision, so you are very wise to come here and get a briefing to see if it's right for you. And we have obviously one of the best presenters available. Jeannie Singleton is with Long-Term Care Partners. She's a senior account manager. She's been with them since 2004, and before that she had 20 years in private sector account manager. She's a certified senior advisor, and she speaks off. I work part-time at FSI, and I've introduced her there many times at the retirement planning courses, so obviously she's the go-to person for long-term care. So she'll give a presentation, and she would like you to hold your questions to the end, and at that point you can let it go with the questions. And I think we have a microphone in back because we're recording this for online content. So let me turn it over to Jeannie.
Thank you so much. Good afternoon, everyone, and thank you for welcoming me here to this beautiful facility on this gorgeous day. I know you'd rather be outside. I am Jeannie Singleton. I am a certified long-term care consultant, a long-term care professional, and a certified senior advisor. I don't sell insurance. My job is to introduce you to the federal program. If you want more information about it, we will go into how to get that at a later time during this presentation. So our agenda, oh, that's right, they told me it's counterintuitive. Up means no and down means yes. So we're going to talk about long-term care, what it actually is, the realities of long-term care. Are you covered under any program that's out there? And then we're going to go into the federal program. We're going to kind of build a policy, so you're going to know what decisions you would need to make if it's something that you want to get further information about, and then we'll go into next steps or things to consider. So with no further ado, let's talk about one of the most exciting things you can think about, especially on a beautiful Tuesday afternoon, long-term care. So what actually is long-term care? Well, it is actually non-skilled care. So it's the kind of care that anyone can administer to anyone as long as they have the physical ability to do so. So as an example, today I got up out of bed, I visited the bathroom, I took a shower, I had a little something to eat, I got dressed, and when I got out of bed, that was called transferring. So that's one of the activities of daily living. And the other activities that I performed, as you see up here, are just the things that we do every single day. And those are considered the ADLs that would make you in need of long-term care. So if you needed help with those activities, 2 or more, you would be considered ADL dependent or in need of care. The long-term part means the care is going to last 90 days or longer. And typically you're not going to get better. This is going to be something that's going to be a chronic condition. It's not acute care. You're probably going to have this last for a very long period of time. So long-term care is either physical hands-on assistance, as I just mentioned, or it can be supervisory assistance. You have a cognitive issue, Alzheimer's disease, or dementia, or memory loss. You might physically be able to perform all those activities, but you might not remember to perform those activities. Or you might need someone to gently remind you that it's time to eat, or it's time to get dressed. Or you just might not be able to be left alone because you might harm yourself or you might harm others if you're not being supervised. So long-term care is either hands-on assistance or supervisory assistance or a combination of both. The situation is expected to last 90 days or longer, and typically it's not something you're going to get better from. How uplifting is that? So, why are we going to talk about this? Well, the reality is we are all going to live very long lives. And statistics say that the longer we live, the more likely the need for long-term care arises in our lifetime. After age 65, that number grows exponentially. So statistics also say that 70% of us will need care. 30% of us will not. 100% of us want to believe that we won't need care, right? We all want to believe that we're going to be well and healthy until the day that we no longer are living. But unfortunately, that's not the reality. And when long-term care becomes a part of someone's situation or life, if it hasn't been planned for, it may become a very big issue for not just you, but for your family members or friends or anybody in your sphere of influence. Because long-term care is expensive and it can derail all all the financial planning you do throughout your career or as you get into retirement, because if you haven't put that in your financial puzzle, you might be missing a big piece. So, where does long-term care take place? Well, lots of us think about facility care. So we think about nursing homes, or we think about assisted living facilities, and now we have things called continuing care retirement communities, where you can actually age in place and move through care spectrums in that type of retirement community and not actually have to leave a home per se. But most often, long-term care takes place at home by family members providing care to those that we love. And we take care of people that we love because they took care of us, or because we feel the duty to take care of those individuals. Or we live the closest to that person, or we have the biggest house, or we have the most resources, or our car is big enough or easy enough for that person to get in and out of. So sometimes we become caregivers not because we choose to be, but because of where we actually live and where that person actually resides. Caregiving is difficult, and any of you who have been a caregiver or watched a caregiving situation know exactly what I'm talking about. 80% of caregiving in the United States is provided by people who are not paid. So people who are just out of the goodness of their heart or because they love someone, take care of that individual and have to not have any kind of income stream. What we see a lot of times is that when people become caregivers, the stress of that caregiving actually can make the person who's the caregiver sicker than the person that they're taking care of. Because that actual caregiving duty becomes an actual burden that makes that person's immune system compromised and makes them into a situation where they may get sick sooner rather than later. So we really need to be careful about caregiving and how we're taking care of our caregivers. The United States has an actual epidemic of caregiving situations where people are not getting supported and they're having issues and getting sick. So unpaid caregivers are where we're going in the U.S. What would long-term care look like for you? Who would be your caregiver? Who would be the person that you would think in your mind would be taking care of you if you should need some long-term care? Got a name? Got a face? I see some smirks. I see some points at each other. Have you told the person that you're thinking about that that's what you're thinking about for them? Have you had a conversation with them that I expect you to take care of me? That my expectation is that it's going to look like this. Because we can think in our heads how that caregiving might look, or we can think because we birthed someone, or they're our relative, or they're our best friend, or they're our spouse, or they're our domestic partner, that they're going to take care of us. But they may have no clue that that's what's going on in your brain. So now we get to the discussion piece. How do you open up a dialogue and have a conversation with someone to say, I deem you my caregiver, and I would like you to do these duties for me, and I expect it to look like this? Does anybody really want to have that conversation? No, we really don't, but we really have to. I can tell you my story. Back 2004, when I started with Long-Term Care Partners, I knew nothing about long-term care. It never even occurred to me. So I went over to talk to my mom and dad. They lived right down the street from me in New Hampshire. That's where I'm from. And I'm a first-generation American. So I knocked on my parents' door. My mother lets me in. What do you think she does? She brings me to the table. She sits me down. The cookies are starting to flow. The coffee's coming. She's trying to have, make me all feel good. And I said, Mom, can we stop here? I want to have a conversation with you. And she said, what is this conversation about? What do you want to talk about? And I said, Mom, I want to talk about long-term care. You and Dad are getting older. I want to know what you think a long-term care situation would look like and how we would address it. And she stood up from the table, and she pointed her finger at me, and she said in our native tongue, Eviania, that's my name, I changed yours, you're changing mine, we not talk about this anymore. Conversation is over, done. And I hear my dad in the other room, that's right, that's what's happening. Okay, did I not know that's how it was going to go down? I just needed to hear it, right? Okay, so got my duties. I know I'm going to be the caregiver. Well, it's 2018. Fast forward 14 years. Dad's 86, Mom's 82. We were all living in New Hampshire together, right? All happy down the street from each other. Well, about 10 years ago, brother number one had a baby. And my brother number one lives in Los Angeles. And where do you think the grandparents weren't running off to? For 1 year, we're going to go to LA and we're going to stay with Stavros and take care of him. Well, Stavros is 10. Okay. Karsten is now 8, and now we have new Alexander, who's 4. Guess where my mom and dad live? Los Angeles. Do they live in New Hampshire where I live? No. My dad needs to go to the doctor every other day because he's starting to get a little bit frail, a little bit sick. He needs, memory's not so great. Am I there to do all those things? Nope. Guess who's doing it all? My sister-in-laws. You know why? Because they're not working. So they have nothing better to do, right? My mom is helping take care of the kids so that my sister-in-laws can help take care of my dad. Well, guess what? That wasn't the plan, was it? So when you're thinking about the person that you think is going to take care of you, it's really about where their life is going to be when your caregiving situation actually happens. And if, in fact, you want them to be your caregiver, put the plan together so that if someone's moving halfway across the world, you know where each other are, and you can then make that plan based on that. But if you don't have the discussions, like mine, you never know where you're going to be and how it's going to look. So start the dialogue with your friends or family, kind of, ease into it. Don't quite do it like I did. Maybe you need to just kind of plant a little seed and then start talking a little bit more about it, and then find out what the expectation is from them and from you, and map it out. And there's actually 2 really good websites that I encourage you to look at. One of them is called agingwithdignity.org, and the other one is called GoWish, GoWish.org. And both of those sites have tools that you can use to start dialogues, and they also have planning pieces that you can actually put a plan of care together. So how would caregiving look? Where would we get the money? And there's also on the agingwithdignity.org site, there are documents out there, things like durable power of attorneys, medical health care proxies, and also your living will, so whether you want to have a DNR or not. And those are really good things to have in place no matter what age you are. I encourage you to have those documents in place. Because if you don't know already, if you get sick, and even if you're married to someone, they cannot act on your behalf unless you have nominated that individual through a healthcare proxy as the person who can act on your behalf. So that's a very important document to have in place no matter how old you are, no matter where you are in your life. It names the person you'd like to have act on your behalf. It's documented through a doctor's office. They can keep it at a hospital, or you can actually have an electronic copy on file on the internet. And if anything ever happens to you, that form is right there, and they know who can speak on your behalf if in fact you can't. So I encourage you to look at those sites. I encourage you to have a dialogue with your friends or family, start the conversation, and figure out where your plan of care is going to go or how your caregiving is going to look. And everyone's on the same page, so if something should happen, we all know what steps we're taking. So enough about that. Let's talk about how expensive long-term care is. So this is a beautiful map of the cost of care in most parts of the United States. And as you can see, surprise, surprise, Washington, D.C. is really expensive. What a shock, right? Not like anything else in Washington, D.C. is expensive, but long-term care is expensive. So these are annual costs for care for nursing homes and home care. And you can see that the U.S. is broken up by the East Coast is really expensive. The southern parts of the United States are much less expensive. Why is that? Because more people flock to warmer climates as they get older. So there are more services available, more resources, and so if there's 20 nursing homes or 20 facilities in an area, it'll be a little bit more competition than if in fact you're only having 1 or 2. And that would be the case in Bismarck, North Dakota. That's why it's so expensive up there. Even though it's a very inexpensive place to live and housing is inexpensive, if there's only one choice, that place is going to charge whatever they want to charge, and if you need that, kind of care, you're going to have to pay for it because there aren't any other options. So you want to look at where you're thinking about retiring and look at the cost of care and see if you can manage that, because that's 1 year's worth of care. Imagine if you needed what an actual caregiving situation is, about 2.7 years worth of care. How would you afford to pay for that? And would you advance your TSP, or would you make the other people in your family not be able to have a great life having to pay for your long-term care? So those are things to think about. What are your options for paying for long-term care? Well, you can pay for it by yourself if you want. If you have the money, absolutely pay for it by yourself. If your retirement income is such that it can afford you to have the ability to pay for your own care on your own, then by all means do that. That's an option for you. Just make sure that the people who are in your sphere of influence understand that that's what you want that money to go to, and that they understand how to have access to it, and that they are able to write out the checks. Because if that's what you want, make that wish known. If that's not what you want, then make that wish known as well. You don't want to spend your money that way. If you have investments, you can use your investments to pay for long-term care. Again, when the time comes, you need to make sure those people who are going to act on your behalf have access to that money, so they're not scrambling and trying to get at it. So you can work with elder care attorneys, or you can work with an estate planner to make sure that those pieces of the puzzle are put together so that if something happens, they're able to get at that money, and only when that something happens. Because if they're like me and they want to go buy a nice red car, I don't want to have access to anybody's money before they need it, because that might be what I do with it and not use it for what it's intended to. Sorry. Okay, what about government programs? Let's talk about some of those, and then we're going to go into insurance. So what about disability insurance? Long-term disability insurance and long-term care insurance get confused oftentimes because they have the term long-term in them. Disability insurance is an income replacer when you're actively working. When you go into retirement, disability insurance goes away, so it's not something that's available. Does health insurance pay for long-term care? Does anybody know the answer to that? The answer is absolutely not. Health insurance is designed to take care of you if you're going to get better. And certainly if you have a knee replacement surgery and you have a little bit of rehabilitation, your health insurance is going to pay for that care surrounding that. But if you have knee replacement surgery and it becomes a chronic situation where you're going to need long-term care because you didn't get better the way they thought, then long-term care insurance would come into play. Your health insurance would stop, long-term care insurance would come in. Health insurance would pay for all of the things regarding and revolving around that, but they wouldn't be the ones who are paying for the actual caregiving that you might need. What about Medicare? Does Medicare pay for long-term care? Does anybody know that answer? No. Answer's no. You found that out the hard way, right? No. No, you just know. Okay. So how Medicare works, Medicare Part A, which Medicare is health insurance, you know that. Medicare Part A has a benefit within it that pays for rehabilitative care, and it looks like this. Medicare will pay for you up to 100 days if in fact you need rehabilitation in a skilled facility. However, you must meet the following criteria. You must spend 3 or more nights as an admitted patient in a hospital. How hard is it to get 1 night in a hospital, let alone 3 nights? And you must be admitted. You cannot be under observation. So you must be admitted. And if in fact you are admitted and you stay there for 3 nights, then the Medicare benefit kicks in. Medicare will pay for day 1 through 21 if you've satisfied that 3 or more nights at 100%. So day 1 through 21, they pay at 100%. Day 21 through day 100, Medicare will pay for you after you pay a copayment. The copayment per day in 2018 is $167.50 per day. So you would pay that from day 21 through day 100. Medicare would pick up the difference. At the end of that 100 days, your Medicare benefit is exhausted. So there is no more Medicare benefit.
Sorry, could you just say that again?
Sure. The copayment in 2018 is $167.50 per day. So 21 through 100, okay? So once that 100 days has elapsed, you're all done, and you can only do that once per calendar year. So it's not a rolling situation where then you go back into the hospital and you start over again. If you don't use up that full 100 days in that calendar year, you are eligible to go back and use them again. You don't have to satisfy that 3 or more nights again. If you've satisfied it once per you've satisfied that once per calendar year. So really, Medicare's benefit is day 1 through 21 at 100%, and then day 21 through 100, you pay that $167.50 per day. Every year that copayment rises, so every year that goes up. All right? So Medicare doesn't pay for long-term care. What about that magical Medicaid? Anybody remember the 80s? Do you remember when people who were wealthy were going into nursing homes and the government was paying for it? And there were all these elder care attorneys going around hiding everyone's assets and putting them in other people's names. And it was just this really unbelievable scam that was going on. And people were literally getting their nursing homes and assisted livings paid for. And then at the end of the day, all their wealth would still be preserved for their family to take on to the next level. Well, government got smart. And now they have things called look-back periods. So let's say, as an example, today, will you be my friend?
Sure.
Okay. Today I'm going to bequeath you all my assets. May 1st, 2018, I am going to give you all of my assets.
I'm buying a red car this
You are?
afternoon. I want you to know
Okay.
that.
Good. I want to go for a ride in it. So today I'm going to bequeath you all of my assets. The only thing I'm going to be able to keep is my home. I'm going to live in that, and it's not considered a countable asset while I'm living in it. So today, May 1st, 2018, you now have all of my assets. I go through life, and on May 1st, 2021, I need to go to a nursing home. Do I qualify for Medicaid? Why not? Who says no and why not?
5 years.
5-year what? There's a 5-year look-back period, right? I needed to wait to get sick for 5 years because that red car that she just bought with my money actually is mine now because it's still a countable asset to me. So there is a 5-year look-back period on that asset transfer that I give to her. So any assets that are transferred, you must wait 5 years for those to not be countable towards you. That's the only way you can hide them. Some states now have a 7-year look-back period. And I have a strange feeling that as I'm a baby boomer, as we boomers start to make the system tax a little bit more and more, that 7-year look-back period is going to probably be more of truth versus a small percentage of states. So the look-back period makes me ineligible for qualifying for Medicaid. However, if I had satisfied that 5 years, would I be eligible for Medicaid anyway? The answer is I would only be able to have $3,000 of countable assets in order to be eligible for Medicaid. The point of my story is this. You can hide your assets all you want. When you're a federal employee, what did you work your entire career for? A pension. What's a pension? A paycheck. What's a paycheck? An asset. What can be hidden of a paycheck? Nothing. So your paycheck becomes your liability when it comes to Medicaid. And you could still qualify for Medicaid if you wanted to give your paycheck to a facility to take care of you. And if that's what you want to do, by all means, you go for that. You let that be your plan. However, if there is someone else in your life that's depending on that income to help them live, how are they going to live their life if that's what's going to pay for your care? So Medicaid is typically not an option for most people. There are people that it is an option for. You might be thankful that it's not one for you because it really doesn't give you the greatest care. It gives you semi-private room and a Medicaid facility. You probably wouldn't even want to bring your dog there if you had one, okay? So Medicaid doesn't pay for long-term care unless you're really, really at the bottom of the tier of poverty. What about the VA? And if you're a veteran, thank you for your service to our country. The VA provides great health care. Long-term care, not so much. They're now going into a situation where it is based on your service-connected disability. The higher your disability, the more likely you might get some care from the VA, but it doesn't necessarily mean you will. If you are a veteran, I encourage you to contact the VA now, and they can actually give you information and tell you, yes, you would qualify, or no, you wouldn't qualify. This is what you would get, or this is what you would not get. And then you can jump off from there and know how to go through your planning phase from that. So, have I depressed you at all? VA is not going to pay, Medicaid's not an option, Medicare is not going to pay, health insurance doesn't pay, disability insurance doesn't pay. Who pays? You pay. So what's your plan to pay? Could insurance be an option for you? That's up to you to decide. My job is to tell you about the Federal Long-Term Care Insurance Program. We have a plan that covers comprehensive coverage. You can get care at home, assisted living, nursing home, adult daycare. We will actually pay for continuing care retirement communities once you're in the caregiving spectrum. We won't pay for it when you just move in, but when you're in the caregiving spectrum, we will pay for your care. We also pay for hospice in a facility or hospice at home. The federal program has a hallmark, and the hallmark is that you can select your own caregivers. So you pick your caregiver. It can be someone as close to you as your own children, and they can administer your care, and you can pay them in order to do so. So it's not so bad taking care of mom or dad if we're getting a stipend in order to do so. We don't have to give up our livelihood or our income in order to do that caregiving. If you didn't want your children to take care of you, or that wasn't an option for you, any friend, family member, cousin, niece, nephew, someone you find walking down the street that wants to take care of you, anybody can take care of you. You select who that caregiver is. You can receive care in their home, or you can receive care in your home. You decide who your caregiver is, and that person can provide your care for you. Uh-oh. There's some patches. What am I doing?
Go over to the computer with your mouse on continue working.
Okay. Thank goodness we have a techie in here. Okay. Thank you for that. Okay. So the hallmark is you select your own caregiver. It can be someone as close to you as your own family member. If you prefer to have a formal caregiver, you certainly can do that, but just know a formal caregiver is going to charge you a lot more money, so your plan dollars won't go as far. So that's why the informal caregiving is such an important piece of the federal program. So,
But not your spouse.
your spouse is not eligible to take care of you and be paid. Yes, your spouse or domestic partner. Sorry. That's what, for better or worse, richer or poorer, your sickness, my health, that's what that's all about. This is not moving now. Hello, where's my tech people? Well, let's see if I can do it this way. Oh boy, guys. Okay, well, I know what the next slide says. Let me see. Yeah, not happening for us. Who gave me that advice? Do we have... Ah, there we go. Okay, that was because I moved the mouse and clicked it. All right, so if you're looking at the federal programs, there's actually 3 essential decisions that you need to make. What you want your plan to pay per day for your care, and we're going to go through that. What you want your benefit period to look like, and we're going to go through that. And then we're going to talk about inflation protection and how that looks for an enrollee as well. So daily benefit amount is your first decision. Daily benefit amounts start at $100 a day, and they go up to $450 a day in $50 increments. Well, how the heck am I going to figure out what I need for a daily benefit, right? That sounds like a lot to ask. Well, we actually have something online called a cost of care calculator. And the cost of care calculator, as you see on the left, you populate it with the state, and then you populate it with the nearest city to which you either live in or think you're going to retire in, and you press find the cost of care, and it will tell you in today's dollar how much it costs to be cared for in that particular area. So you use today's dollar as your guideline to pick your daily benefit. So let's say you're going to retire somewhere in the South, but you really don't know what state. What I suggest that you do is check a few states and see what the cost of care is. And you'll see that it's kind of similar in most areas. So if you look at some of the southern states, the eastern southern states, the cost of care is going to be very similar. If you look at the western southern states, the cost of care is going to be really similar. Where it changes a lot is on those coasts. So if you look at the Pacific Northwest and the Northeast down through DC, it gets to be more expensive. So think about where you're going to retire and kind of gear your plan around that. You can also use this plan internationally. So if you're thinking you're going to retire in a foreign country, that's certainly an option and you're able to use the benefits there. The only thing we don't have available to you is what the cost of care is in any other places besides the US. You'd have to do that due diligence on your own. But you can receive benefits in any part of the world. So let's say, as an example, this is Washington, D.C., and I'm not going to use this as an example because it's too darn expensive. I'm going to use where I'm going to retire. I'm going to retire in Charleston, South Carolina, in my dreams, but that's where I'm going to retire. And I did my cost of care, and I found out that an assisted living facility costs $131.86 per day. Now, I know, based on statistics, that very few people actually go to nursing homes anymore. And in the federal plan, the claims that we get, only 12% of our claimants actually ever go to a nursing home. So most people are getting their care at home or they're going to assisted living facilities. So I'm going to gear my thought about long-term care around I need to have enough money to pay for assisted living. If in fact I needed to go to a nursing home, well, I'd address that at that point. But I'm really more concerned about what reality is. And reality is I'm going to get my care at home or I'm going to get my care in assisted living. So that 131 is going to be the number that's in my head. So I'm going to select $150 a day as my daily benefit. That will give me enough to pay for that assisted living, and it'll give me enough to pay for home care, and it will also have, if I did need to go to a nursing home, I'd have to pay about $60 out of my own pocket per day. And that would be palatable for me. I wouldn't have to pay everything. That $60 would be palatable, okay? So $150 is going to be the daily benefit that I'm going to select for myself. You select your daily benefit based on the cost of care in the area you live in or the area you think you're going to live in when you go into retirement. You don't need to insure yourself fully for the cost of care. Think of insurance as a tool. So if the cost of care is $300 a day and you insure yourself for $200, you know you've got $200 to cover and to protect your assets, and that other $100 may come out of your income, and that wouldn't let you miss a beat. You'd still be able to live and enjoy life. So don't look at insurance as the actual be-all and end-all. Look at it as a tool to help you move to the next step. So cost of care based on the daily benefit based on the cost of care in the area you live in or the area you think you're going to live in when you go into retirement. So next decision is your benefit period. We offer 2 years, 3 years, 5 years, and unlimited. Unlimited benefits are too much insurance. Bottom line, if you need long-term care, are you going to live an unlimited period of time? The answer is probably no. The average long-term care situation in the U.S. is 2.7 years. Unlimited benefits are way more insurance than most people need. If you have nothing better to do with your money than pay for long-term care insurance and unlimited benefits are what you want, by all means, that's the plan you want, you buy that. I am not an advocate of unlimited benefits. I look at Christopher Reeve. Remember him, Superman? He fell off a horse. He was very young and healthy. He lived 9.5 years needing care, and he had the best care you could possibly get. So there's a young guy. He doesn't live an unlimited period of time. When you're older and you're needing long-term care, do you think you're going to live an unlimited period of time? Answer is no. So kind of cross off that unlimited benefit out of your brain because it really isn't, too much is really not the best when it comes to long-term care. So what do people usually pick? They pick the 3-year benefit. 2.7 years on average. That typically is the most popular benefit that we offer. Certainly you could pick a 5-year, you can pick a 2-year, but remember the average situation is 2.7 on average. So this is how it actually looks. We take our daily benefit amount, which is $150 a day. We take our 3-year benefit that we selected for ourselves because we think we're going to fall into that average category. But 3 years actually translates out to 1,095 days because the way insurance providers pay out or the way caregivers bill or facilities bill is they say it's going to cost you X number of dollars per day to be here. So that's why we translate it out into daily benefits. So 150 times 1,095 equals a pool of money. That pool of money in today's dollar is $164,250. That's what you're insuring yourself for. You're insuring yourself for that pool of money. So the way it looks is this. Every day that you have an expense, that expense, whatever it is, up to $150, comes out of your pool of money. If you don't spend your full $150 every day, whatever you don't spend that day stays in your pool of money to use later on. So now your 3-year plan is actually longer than 3 years. So your pool of money never expires. It expires when you no longer are living and your plan is over, but it doesn't expire if you still have benefit. So how it looks is this. I get care from my daughter's friend. She charges me $100 an hour, $100 a day, sorry. Every time she charges me $100 a day, I leave $50 in my pool of money to use later on. After that year goes by, the first year, I've only spent $36,500 of my pool of money. So now my 3-year plan's probably extended out about 3.5 years. So I now have a longer benefit period. Here's the kicker. After that year's over, my daughter's friend comes in and says, I want $200 a day. I can't deal with this woman. She's driving me nuts. And my daughter says, well, why not? You know, you can get $200 a day because she didn't spend the whole $150 every day. Answer's no. She can only get $150. The plan will never give you more than your daily maximum per day. So your daily maximum protects your plan from being used up any sooner than the number of years or days in your plan. So you can extend it out for a longer period of time, but you can never use it up any sooner than the number of years or days because we're never going to pay out any more than your daily maximum. Is that clear to everybody? So your pool of money can last for longer. It can never be used up any sooner than those number of years or days because we'll never pay out more than your daily max. So daily benefit times the number of years or days in your benefit period equals your pool of money. Your pool of money does not expire until you are no longer using the program or have passed away. If in fact you leave money on the table, that money goes back into the insured's pool for everyone to share. So there's nothing for you to pass on to anyone. It is your pool of money, but once you are no longer around, that pool of money goes back to the other insureds. Okay? So now we have inflation protection. We have daily benefit period. How are we going to protect our plan so it has a value to us in 20 or 30 years when we might need it versus today when we're young and healthy and happy? So we have 2 options for inflation protection. One is an automatic compound inflation option, which I will get into in a moment, and the other is a future purchase option for inflation. So they look like this. Automatic compound, your daily benefit, so that $150 that we talked about and that pool of money, that $164,250, under the automatic compound, that $150 grows and that $164,250 grows 4% or 5% compounded annually based on the year's previous amount. So every year that $150 grows, every year that pool of money grows, all you're doing is paying your premiums. Nothing's changing, your benefits are just growing. So when you go in to claim, your daily benefit and your pool of money will be the equivalent of how many years you've been in the program. So if I have my plan for 30 years, I know that $150 a day will have inflated up to about $399 a day, and I know that that pool of money is going to equal something around $438,000. All I will have done is pay my premium. Daily benefit will grow, pool of money will grow. So that's how the automatic compound inflation option works. The other option is a future purchase option for inflation. So this is really an easier way to show this chart, show this philosophy. So if I were 50 today and I bought that $150 a day 3-year plan with a 4% automatic compound inflation option, my premium would be $50.29 biweekly. Every year I pay my premiums, every year my daily benefit grows, every year my pool of money grows, 4% compounded annually. If I bought the 5%, I'd pay a higher premium and my benefits would grow at a higher rate. Now let's say that third column, the future purchase option. That's the one I'm going to talk about now. The future purchase option means I'm paying a lower premium. See, it's same plan, $150 a day, 3 years, but I'm only paying $17.72. Why is that? Because those automatic inflation options are not being added. So I'm getting a flat rate. I buy that $17.72, and I'm getting that $150 a day with a 3-year benefit. And every year when that person with the automatic benefits, their benefits grow, the future purchase option person's benefits stay level. Well, we would not do that to somebody, would we? Absolutely not. What we do is every 2 years we make an offer to that person who has the future purchase option. And we say, dear Mr. or Ms. long-term care customer, would you like to keep up with inflation? And we use the Consumer Price Index for urban customers as our guideline. And let's say that index was 3.5% over the past 2 years. We would say, dear Mr. or Ms. long-term care insurance customer, would you like to buy 3.5% more coverage? And if you say yes, we say okay. We're going to give it to you, but it's going to be based on your new age. So your $17.72 is your flat rate because you started at 50, but now you're 52 because it's 2 years later. That 3.5% more coverage, we're going to rate it at your 52 years of age, okay? Does everybody get that? So now we're going to add, let's say it's $3 for that particular cost. Your base rate, $17.72, is going to get $3 added to it because now you're buying more coverage. Your daily benefit grows, your pool of money grows, but you're paying for it. Two more
per pay period.
per pay period, and I'm just using numbers. These aren't necessarily accurate. Okay, these are just thought processes. 2 more years goes by. Now this 50-year-old is now 54. We make the offer again. Rate of inflation was 4%. We say, would you like to buy 4% more coverage? Sure, I'd love to. But now you're 54. That 4% more coverage is going to cost you $6. Again, I'm making these numbers up. So we're going to add $6 to your premium. Your daily benefit's going to go up. Your pool of money is going to go up, but you're going to be paying. And see how the thought's going to go. The older you get, the more expensive those offers are going to be, because every year that you get older, the attained age gets up there and the rates for those attained ages grow. So with the future purchase option, if you start out with that at a younger age, under about 65, you are going to end up paying more for your policy in the long run versus starting with the automatic compound and letting your benefits grow slowly over time. Even though the premium is bigger, it's still going to save you money, because if you want to keep up with inflation, you're going to want to keep saying yes to those offers. So future purchase option means your benefits start out, your premium starts out lower. Every 2 years we make those offers. You say yes to them. Your benefits grow, but your premium also grows as well. Clear? Unclear? Sir?
What if you don't want to exercise your option in year 2, 4, 6, or 8, and you want to exercise it in year 10?
So you don't, under the current program that we have, under FLTCIP 2.0, if in fact you want to say no to any of the offers, you may do so. You have unlimited declines. So you can say no as many times as you want and yes as many times as you want. The only time we will not make you an offer under the future purchase option is when you're in claim, because you're no longer paying premiums when you go into claim anyway. But that's a great question, because I'm going to segue into another way to buy long-term care insurance. So these are the traditional thought processes. So this is what we've been teaching for about 11 years. We taught this way. And then we kind of got this like, la, that came over our heads. And we now have a different way to teach for certain age groups. So this age group that we teach, this particular thought process is about 50 to about 67. And it still can work at a later age as well, but it doesn't need to be as aggressive. So here we go. Daily benefit, benefit period, inflation protection. Everyone clear on those 3 things? Madame.
I'm not clear about, if you have accepted an increase in this, you're offered the benefit, the increase, you accept it. Does that stay at that level, or does it go away after 2 years?
No, it stays at that level. So your benefit has grown to whatever that is, and you're paying for it. And then if an offer is made 2 more years later and you don't want to accept it, you're still going to have what you have. That doesn't go away. Right. Yep, at the same cost. Right. Okay. So this is traditional. Now we're going to talk about the fun stuff. So let's say, as an example, and I know this chart is really small, I'm 50 years old today. I only wish I was 50 years old, but I'm 50 years old today, and I buy that $150 a day, 3-year benefit with a 4% inflation protection, and I've got that $50.29 biweekly premium, right? And every year my benefits are going to grow, and every year I'm paying my premium right along with everything else. And I decide that that is a great option for me. I already told you that in 30 years, that 150 is going to look like $399, right? And I already told you that pool of money is going to be $438,000, or I think it's $437,900. I already told you that, right? So I'm 50 and I'm thinking in my mind, how can I use this to my benefit? Let's look at a $400 a day daily benefit today, and let's look at a 3-year benefit period and a future purchase option. And I buy myself a $438,000 policy today at age 50, and my premium's $47.25. And every 2 years when those offers are made to me, what do I say? No, thank you, because guess what? I already inflated myself up to age 80 when I was 50. So the thought process is, it's called front loading. So you buy a bigger daily benefit up front with a future purchase option, and you say no to those offers as they're made to you. This works because it's typically less expensive than saying yes to those offers as they're made over the course of time. You really need to sit down, depending on your age, you really need to sit down and see if that works. But what I suggest to anyone is if you're over 65, the automatic compound inflation option should not be even in your head. It doesn't work when you're at that age, because it takes about 14 years of using that benefit or having it to actually realize the benefit of paying that extra premium. The thought process under this, the $438 and the $400 a day, is what if you got sick sooner rather than later? What if you got sick when you're younger? That pool of money can be used for that longer period of time. And you're really actually saving premium. You're not spending as much as you would under the automatic compound, and you're not having to wait 30 years for that benefit to inflate up. I know it's a big concept given everything else that I'm talking about, but it really is a great way to look at buying insurance if it is something that you're thinking about. Is it going to work for everybody? It might not. Now, when you're a little bit older, you might not want to inflate up for 30 years. You might want to only inflate up for 10 or 15 years. So you pick your daily benefit based on that, okay? Does that make sense for everyone? Sir?
But then, in that, let's say you're 65 or in your mid-60s and you had the inflation adjustment package. Is there a way to convert it?
So when you already have the automatic compound inflation option and you've been in the program for a while, you may have to go through underwriting to switch over dependent upon what your daily benefit you would want under the future purchase option. The answer is it just depends on what you have now versus what you're looking for, but typically you'd have to go through underwriting for that increase in coverage because that's what it would be considered. We cannot take away what you already have, but we may not approve you for that extra increase. But you can go through that option if you'd like to, certainly. So this is a whole nother way of thinking about buying long-term care. And certainly if it's confusing, you can go out and you can actually use the same calculator. It's out on our website. You can fool around with it, or you can call us and we can give you the information right over the phone, or we can email it over to you. Are there any questions about this before I move on? Sir. Todd. Hello. Automatic compound for age 65 and older is typically not the best value because it takes about 14 years to realize the actual amount that you're paying in premium to have a value of the daily benefit. Average age of a claimant in our program, unfortunately, is 77 years old. So, and life expectancy is around 80, 82, so it might not be the best value. Correct. Right, so if I look at myself, if I look at my family history, everyone in my family lives to be in their late 90s. If I bought at my age, If I bought at my age at 57, I might think about buying an automatic compound if I didn't know about this front loading. Because I know I'm going to have some, I hope I'm going to have some longevity, so the value of that plan would be there for me in the future. You have to think about all those things. But as a rule of thumb in the NAIC insurance package that we participate in, 65 and under, more commonly look at the automatic compound or front loading. 65 and over, look at future purchase option as a rule. Every rule can be broken for reasons. Yes?
I don't think this is the same question, but it's similar. If you've had the coverage
Yep.
and you've had the automatic compound,
Mm-hmm.
can you go to the future buyback?
It's the same question, and the answer would be the same. So if you were automatic compound and you want to switch to a larger daily benefit, you want to keep your daily benefit the same and just downgrade to a future purchase option? Yep, that would be a decrease in coverage. All you would need to do is call us, and we can do that right over the phone for you. Okay, and your premium would be recalculated. Okay, based on your age that you were at the time of application. Okay, not your age that you've attained. Okay, any other questions before I go to the next slide? If you already are enrolled in the program and you want to increase your daily maximum or daily benefit amount, then that would be an increase in coverage. You can get a quote for that. We can give you that over the phone, and you'd have to go through underwriting, and we could decline you for that extra increase. But we can't take away what you already have. Okay? So let's go into the next slides. All plans have a 90 calendar day waiting period. All plans have a stay-at-home benefit. The stay-at-home benefit is 30 times your daily benefit at the time of claim. So let's say your daily benefit's $300 a day. 30 times that, $9,000, can be used for things like putting in a wheelchair ramp, changing your bathroom so it's easier to get in and out of, ripping out carpets that might be unsafe for you to walk on, whatever it is to help keep you at home and keep you safe. 30 times your daily benefit. It does not come out of your pool of money. So it's an on top of your pool of money amount. All premiums are based on your age on the day of application. There is no open season for this plan. You can apply at any time. While you're actively working or when you go into retirement, it is your age on the day of your application that continues to be your age within the program. So if your birthday is tomorrow and you apply today, you will be whatever age you are today forever. If you wait, then you will be the age for your next year for the entire year. It's up to the day before your birthday. The plan is medically underwritten. Everyone applies as an individual, and it is your personal health history we look at. If you have 17 generations of a disease and you don't have it, we don't need to know that everyone else had it, okay? It's your personal health history. You can take your plan with you wherever you go. So if you're actively working and you leave the State Department and you want to go work at McDonald's, you want to keep paying your premiums, you will always have this coverage. We can never take it away unless you stop paying your premiums. If you're not interested in applying for yourself and it's not something you want, there are other people in your family that are eligible for this program. Your parents, parents-in-law, and step-parents are eligible while you're an active employee. If you're no longer actively employed, then they are not eligible any longer. If you are no longer actively employed, your children, domestic partner, and spouse are eligible for this program regardless. So actively at work, your parents, parents-in-law, and step-parents are eligible. If you're not actively at work, they are no longer an eligible party. If you're not actively at work or actively at work, your adult children over the age of 18, your domestic partner or spouse are always eligible to apply for the plan, even if you do not, okay? We're the largest long-term care group-sponsored program in the country. No one cares. We are underwritten by John Hancock Life and Health Insurance Company. No one cares. We are sponsored by OPM. Somebody might care, somebody might not care. What you do need to know is this fund or this program does not commingle with John Hancock. So it is its own plan. This is the plan. Government doesn't give us any money. John Hancock doesn't give us any money. We don't give John Hancock anything but the negotiated profit that they have in the contract through OPM. So if we are negotiating for $1 profit and we make that $1, if we make 20, the $20 goes back into this fund for the enrollees to use. If something were to happen to John Hancock, that pool of money gets transferred back to OPM and OPM either manages it themselves or they find another carrier to manage it. So this program is not going to go away if something happens to John Hancock financially, or if something happens to them and they get sold, whatever. It is its own animal, and it moves from wherever to back to OPM's oversight. So that is the good news about the program. Coverage is guaranteed renewable, but premiums are not guaranteed. I don't know how many of you were part of the premium increase. I may have talked to you about that. I may not have. I don't know. But the premiums will not change because of your age or health. Premiums may only increase if you are in an enrollee group whose premiums is determined to be inadequate. OPM must approve an increase in premium, and your premiums may go up if you voluntarily elect to change your plan. So like under the future purchase option, when you exercise if you say yes to those offers, your premium will go up. That's because you chose to do so. Will we have another premium increase? We don't know the answer. Are we working very hard to create a new plan that would make increases completely out of the picture? Yes, we are. We've been working on it for a year. It's very difficult to find something to make so that you know that premiums will never go up, because the world, premiums go up for everything. So we are working on that. OPM has asked us to work on that, and the Senate has asked us to work on that. It is hard. Long-term care is a very volatile and difficult business. There used to be 125 carriers in the business. There are 4 now. John Hancock does not write long-term care insurance anymore. The only long-term care insurance they have is through annuities and life insurance. So they don't write standing long-term care anymore. So the fact that you have the availability of this program is pretty special. And it really is a very good value if you look at what it actually offers to you. Whether you buy it or not, that's up to you. You have to make that decision. We already talked about eligibility. If you want more information, you can go on our website, ltcfeds.com. If you like to look online, you can use the calculators. You can use that cost of care. You can use the actual rate quote calculator. Or if you want to talk with us, give us a call. They're there 8 to 6 Eastern Time, Monday through Friday. There are 7 people who answer the phone. Most of them have been there since the inception of the program. They're not there to sell you anything. You can talk to the same person over and over again. They're awesome. They know their stuff inside and out. I thank you for listening. What questions do you have? None. Yes, ma'am.
Sort of confused about the service benefit in the calendar year versus the consecutive, if you need something. How many
So you're confused about how the benefit period works? Okay, so the benefit period is your number of days in your plan multiplied, and so if you have 3 years, 3 years equals 1,095 days. That is just your calculator for your pool of money. Your daily maximum per day is, in our case that we're talking about, is $150 a day. You might not necessarily need care every single day. You might have a friend coming in to take care of you one day, and somebody else who's getting paid the other day. So the day that you have a compensatory service, whatever money that is spent on that day comes out of your pool of money. Your pool of money can last as long as that money is still there. Doesn't matter if it's a 3-year plan. If you don't spend your full daily max every day, your plan is now maybe a 3.5, maybe a 4, maybe a 5. Depends on how you spend your money. Oh, so the 90 days is a waiting period. So the 90 days is the waiting period from when you put in your claim to when you actually get benefits. Or it could be when your claim is approved before you get benefits. Look at it as a deductible. We say it's the period of time in which we're not paying for your care, but someone else might be paying for your care. You can also satisfy that waiting period by just having home care by a friend or a family member that you're not giving money to. Every waiting period situation is different dependent upon the situation, the disease, whether someone had a diagnosis 5 years ago and never put in a claim and was getting care. We look at every case individually, but it's 90 days that you can't get benefits from us if you haven't satisfied that. So that would be your waiting period. Okay? Does that make sense? Anybody? Todd?
Just to confirm on the 90-day waiting.
Yes.
For many people, Medicare, in many cases, if you have a hospital stay, will pay for skilled nursing care
Correct.
for that period of time. So it works out very nicely.
It can. It depends on the situation. Every situation is different. Like I said, there could be people who are putting in a claim who've had Alzheimer's for 5 years and they've been getting care from a family member. They're not going to wait 90 days. They've already been getting care. They've already been diagnosed. We actually have paid claims for people who have died and the family didn't know that that person had a long-term care insurance policy. They didn't have to wait 90 days. They already had their claim. We go backdate and pay their claim out.
And the number, was it 50 times the DEA?
It's 30 times your daily benefit at the time of claim for the stay-at-home benefit, and that stay-at-home benefit can be used during the waiting period. So your home modification can take place during your waiting period if you're not getting benefits. I think she was first, and then I'll go to you. Go ahead.
You said that you have to stay 3 days in a hospital for Medicare.
So in the Medicare,
I only stay 2 days and then I go home, and then I wait 90 days to get help from my long-term care. So who is paying my 90 days at home?
you are
From my pocket.
out of your pocket. Hmm.
That sounds really good. At least I can drive to the doctor.
Yeah, if they have room.
So statistically speaking, what's the average age when people are diagnosed?
So that's a really interesting question because there's no magical age, right? So when we first started the plan, the average age of an enrollee was about 58. The average age of an enrollee now is 51. So you take, the youngest and you take the oldest, and that's how you come up with an average age. When is it right for you when you're thinking about it? When is it right for you when it's affordable for you? Is it ever right for you? I can't answer that question. Insurance is not for every single person. Not everyone needs long-term care insurance, and most of the time the people who really want it can't get it because they're too sick to get it. Magical age, it's up to you. We get calls from people who just put their mom in a nursing home and they don't want to do that to their own kids. Or they just saw their friend taking care of someone, they don't want to do it. I mean, it's all a trigger. It doesn't matter what age you are. It's affordability too. The younger you are, the less expensive it is. The more likely you're going to be approved for coverage because you're healthier when you're younger. If you wait and you're waiting to save or do whatever and you suddenly become sick and you can't get it, doesn't matter what it costs anymore. So it's really when you're thinking about it when it's right. If you're educating 3 kids, and they're all in college, probably not the right time for you to buy long-term care. But that's a personal thing. Sir?
What would be the grounds for medical refusal?
So there's a series of medical questions that the application actually consists of. Part B of the application is the actual knockout questions. They're kind of depressing, so I'm not going to go over them. You can download them, but they're serious diseases. Like if you're already in a nursing home, already in assisted living, already have Alzheimer's, already need daily care, if you have dementia, if you have Parkinson's, some of the really serious diseases, those are the automatic knockouts. Then from there, the medical underwriting consists of questions based on your health and your lifestyle, your health, not your family's health, your health. We then get the last transcript of your last physical. Or if you're treated for any doctors for specialty situations, we get the transcripts from those. And we make the underwriting decision based on that.
Like what? Most commonly, like what? High blood pressure?
No, well, so it's really, to answer that question would be, I would be dishonest to say I know the answer because underwriting is a very specialized and secretive kind of thing. We don't know what the underwriting criteria is or why. I can tell you that in my experience, some people with diabetes get approved, some people don't. Some people with high blood pressure get approved, some people don't. It's about comorbid factors. If you have diabetes, high blood pressure, and high cholesterol, but you're perfectly healthy in every other way, you might get approved. Now, you might be 18 and have rheumatoid arthritis. You're not getting approved because the problem is you're going to probably need long-term care sooner rather than later. But it's not on the application to say this is an automatic. Smoking, again, it is all based on someone's health. We look at the person as, are they going to need long-term care in the near future? And if the answer is yes, we're probably not going to insure them. Remember, this is insurance. So they're looking to get the healthiest group of people in and pay the least amount of claims out versus trying to get people who are not healthy and actually going to be using the plan. Unfortunately, that's how insurance is. And we don't rate people. So we don't say, you know what, we're going to approve you, but we're going to make you pay more than your friend next to you. It's yes or no. So that makes it a little bit more not forgiving as far as the yeses and the nos. The 6 questions on the front of the application, if you have to say yes to those, you're an automatic knockout. So don't even bother filling out the app. Yes?
What's the history of the premium increases? How often have they occurred?
We've had 2. We had one in 2009, and we had one in 2000 and, what year did I lose my mind? 15. So 15. And the premium increase that we had in 2009 was not as significant as the one we had in 2015. The reason we have to have, or did have, premium increases is because the way the plan and the law is written, every year they do a deep dive actuarially into the program. And the goal is to have enough money to pay claims in 50 years. It's not to make sure we do this or that. It's to have enough money to pay claims. And because we don't get money from Hancock and because we don't get money from the government, it's the premiums that the people pay that dictate whether or not we're going to have enough money. Now, historically, in long-term care, people buy the plan, they pay for it for a few years, they drop their policy, all that money stays in the pool. That's private long-term care insurance. Federal employees don't behave like private sector employees. You have your premium taken out of your paycheck. It's called persistency. You keep your policies. So every one that we write, less than 2% drop off. Now, all those people go into claim. And now claims are longer and they're more expensive. And all those things start affecting that pool of money. That's where premium increases come in, because actuarially we look out and say we're not going to if all these things continue on, we're not going to have enough money to pay claims. Underwriting criteria has changed over the past few years to be a lot more strict, I will tell you that. So things that we used to say okay to, we're seeing claims on, we're seeing them drag out a little bit longer, we might not say okay anymore. So we have to adjust that as well. Will we have another increase? Answer is I can't answer that. The long-term care business itself and the industry itself and the fact that we're all aging as boomers, most of us, at the same time, history is going to start making itself. And our goal is to pay claims. That's all it is. I mean, this plan exists simply to pay claims, not to make money, not to do anything else but pay claims. And if we don't have enough, we have to raise rates. Now, we are looking at designing a new product. We're looking to do all kinds of fun things, but not a lot of fun stuff can happen in long-term care because there's not a lot of choices.
And how much were the increases?
Well, it all depended on how long you had the plan. There were people who had 200% premium increases. However, under the federal program and under the law, we can't just raise your rate. So we can't say, here, you have to have a premium increase. What we have to say is, we have to raise your rates. Here are 4 choices. You can keep your rate the same, downgrade some of your policy, change some of your benefits, change your inflation protection, whatever it might be. So under that guideline, you don't necessarily have to take that premium increase. You have options to keep your rate the same. Sir? So the way the policy works is because it's a HIPAA qualified plan, you can use your premiums towards satisfying that 10, I think it's whatever it is, 7.5% of your income towards writing off, but your medical expenses have to equal that amount. And typically, if you're healthy, you probably don't have that much medical expense. If in fact you did, it's based on your age. So whatever your age is, the government has a certain maximum of your policy that can be written off for premiums. Typically, our premiums are less than that maximum for most people. You can use it towards that, but typically it's not happening for people.
As a person who has had this for some time, I'm interested to know what variables can be changed for a person who has an existing policy.
As-
The number of years,
Yep.
the amount of daily experience.
So you can change anything in your plan. So you can upgrade or downgrade your policy. So if you want to get more of a daily benefit than you have today, that would be considered a policy upgrade. You would need to go through the underwriting process, and we could decline you for that upgrade. We're not going to take away what you have.
So the underwriting process means we got this at a wonderful time when you did not have to initially.
Right.
Didn't have to.
So you probably were in the first open season, or were you in 2011? Okay. So So first open season, you didn't have to answer a lot of questions. You were approved for coverage. You have a $50 a day benefit. Now you want a $100 a day benefit. That $50 you'd have to complete an application for, and we could come back and say, sorry, we're not going to give you that 50, but we're not going to take away the 50 you have. Okay? And anything that you would be approved for an increase would be rated at your new age. So your base premium would stay the same at whatever age you were at the time of application, but if now you're 15 years older, you're going to pay the 15-year older rate for that new piece of the policy. You'd blend it with what you already had. Does that make sense? Okay.
Can I ask one more?
You absolutely may.
90 days.
Yes.
So I'm getting feebler and feebler, and my wife is looking at me and saying, pretty soon I can't.
Why did I
handle
marry him?
this, but I could hang on for 90 days.
Mm-hmm.
Does that mean, what triggers the 90 days?
So when you put in your claim, so whenever your claim goes in, they do an analysis, they do an actual verification of your claim, what have you, what have you. Now, it may have been that your wife was taking care of you at home for the past 2 years, but you didn't put a claim in. We may not make you wait 90 days. It's going to be case-by-case scenario. If you were getting some kind of care from your spouse, we may not make you wait those 90. Now, and it also depends on it also depends on what plan you have, because the first plan that we had, FLTCIP 1.0, the original policy, it was not a calendar day waiting period. It was actually a day of service. So you had to have an expense every day in order to satisfy that waiting period, which could mean, in that situation, it could be more than 90 days if you didn't have an expense every single day.
90 service days.
90 service days are different than 90 calendar days.
Pay money to somebody for 90
Correct. Correct. In the plan that we have, 2.0, it's 90 calendar days regardless, whether you have a service or don't have a service. We're just making you wait, ticking those days away.